DSCR loan for rental property investors in Miami and Los Angeles is often described as a unique approach that focuses on the property's income potential, rather than traditional income statements. You're watching Real Estate Capital and Growth USA, where we explore the most relevant financing structures shaping today's real estate market. Have you ever wondered how certain investors in competitive markets, like Miami and Los Angeles, scale their rental portfolios without relying on their personal income? Many of them rely on a financing framework where the property's performance plays the central role. In this video, we will explore the concept of the DSCR loan, what it is, how it generally works, why it has gained traction in Miami and Los Angeles, who typically uses it, the common eligibility parameters, and the broader considerations often discussed. Warning disclaimer. This is for educational purposes only, no financial advice, no legal advice, and no recommendations. Our aim is simply to explain. So let's start with the foundation, defining what a DSCR loan really is. DSCR loan, what it really is. DSCR loan for rental property investors in Miami and Los Angeles is one of the most unique financing structures because it shifts the focus away from personal income and directly onto the rental property itself. In other words, instead of looking at pay stubs or tax returns, the lender evaluates whether the property can sustain itself. This perspective has made DSCR loans a relevant discussion in U.S. markets, where rental income potential drives many decisions. Now, let's take a closer look at what DSCR really means, how it's calculated, and why it matters for real estate financing. The definition. DSCR stands for Debt Service Coverage Ratio. A DSCR loan is a financing approach where approval often relies on the rental property's projected performance. In this model, the investment unit is treated like a standalone business. For example, in Miami, condos in high-demand rental neighborhoods are often evaluated by comparing their projected monthly rent against the potential mortgage obligation. Similarly, in Los Angeles, multifamily properties follow the same framework, where the cash flow of the property itself becomes the centerpiece of the evaluation. This makes the DSCR loan for rental property fundamentally different from traditional loans, which usually prioritize the borrower's personal income documents. The formula. At the heart of the DSCR loan is the ratio calculation. The formula is monthly rental income divided by monthly mortgage payment. A ratio of 1.0 means the rental income is equal to the debt. Ratios above 1.0 suggest that the property generates more income than it costs to service the loan. For instance, a property in Miami producing $5,000 in monthly rent against a $4,500 mortgage has a ratio above 1.0, signaling coverage. In practice, lenders view these numbers as a way to measure whether a property can sustain itself financially. While each lender has their own criteria, the DSCR formula gives a universal snapshot of rental performance. Why it matters. The DSCR loan for rental property appeals to many investors across the USA because it recognizes the property's income potential as the driver. In cities like Los Angeles, where strong rental demand supports higher cash flows, this calculation can open opportunities for scaling rental portfolios. Certain investors see this as a practical framework because it highlights the property as the core business unit. This makes DSCR loans relevant for those studying high-demand rental hubs, such as Miami Beach and downtown Los Angeles. So now that we've seen how the DSCR loan works and why it matters, let's summarize the key idea before moving forward. In summary, the DSCR loan for rental property is defined by one core principle: the rental property's ability to cover its own debt. By focusing on projected income rather than personal documents, this model frames the investment unit as a business. Whether in Miami or Los Angeles, the DSCR approach highlights the importance of property-level performance in U.S. real estate financing. Now that we've defined the DSCR loan, the next step is to see how it typically works in practice, especially in Miami and Los Angeles. How it works in geographic context. DSCR loan for rental property in Miami and Los Angeles is best understood by looking at how the process unfolds from start to finish. The journey often begins with estimating the potential rental income of the property. This evaluation can be supported by a market rent study or an appraisal, giving lenders a data-driven forecast. That projected rental income is then measured against the proposed monthly mortgage payment, forming the basis for eligibility. In cities like Miami Beach with luxury condos, or Los Angeles with competitive multifamily markets, this method shines because strong rental demand often provides a clear view of the property's performance. Now let's break down the process step by step, focusing on how rental income, property type, and location all play a role. Rental income estimation. The first stage of a DSCR loan for rental property is calculating expected income. Appraisers or market analysts often look at rental comparisons in the neighborhood to determine what a unit can realistically earn. In Miami, oceanfront condos command premium rents that frequently strengthen the DSCR ratio. In Los Angeles, diverse rental markets, from downtown lofts to suburban apartments, provide varying but often robust income potential. This step creates the foundation because the property's income stream is treated as its business revenue. Mortgage payment comparison. The second stage involves calculating the monthly mortgage obligation. Lenders place projected rent against the proposed mortgage cost. If the rent covers or exceeds the payment, the DSCR ratio appears favorable. Take a Miami rental property projected to earn $6,000 per month with a $5,200 mortgage, its DSCR ratio exceeds 1.0. In Los Angeles, a 4-unit multifamily generating $10,000 against an $8,500 mortgage also demonstrates positive coverage. Why geography matters. Geographic context makes the DSCR loan for rental property especially relevant in the USA. In Miami, tourism and seasonal demand sustain high rental values, which can strengthen ratios. In Los Angeles, a mix of entertainment industry workers, students, and professionals drives long-term rental stability. By focusing on the property's own ability to generate income, the DSCR model aligns with how competitive rental markets function. This context shows why DSCR loans continue to gain visibility across the U.S. In summary, the DSCR loan for rental property works by comparing projected rental income to mortgage obligations, with the property treated as a business. In high-demand U.S. rental hubs like Miami and Los Angeles, this approach highlights income-driven sustainability. This analysis is educational and descriptive only. This is not financial advice. Talk to a professional. With the mechanics and geography explained, the next question is, who actually uses DSCR loans? Let's explore the investor profile. Typical profile. DSCR loan for rental property investors in the USA is often linked to a certain type of borrower profile, those who rely on the property's performance rather than only their own income. This financing approach is widely used by self-employed individuals, entrepreneurs, and real estate investors expanding their portfolios in markets like Miami and Los Angeles. For many, traditional lending criteria don't fully capture their financial potential, so a property-based calculation provides a different lens. It is also appealing to investors who are branching into new U.S. rental markets, and who may have already reached their conventional lending ceilings. So who exactly are the typical borrowers that use this method? Let's explore the different categories. Self-employed borrowers. One of the most common profiles using the DSCR loan for rental property is the self-employed borrower. Unlike salaried workers, their income streams may fluctuate or appear reduced on tax filings. For an entrepreneur in Miami running multiple small businesses, or a creative professional in Los Angeles with varied contracts, the property's rental income provides a clearer measure for lenders. This shift allows certain self-employed individuals to access financing opportunities aligned with the property's real income potential. Portfolio builders. Another group often associated with this financing model is the portfolio builder. These are investors scaling from one or two properties to larger holdings, especially in U.S. markets where demand is strong. In Los Angeles, multifamily properties appeal to investors seeking long-term stability, while Miami condominiums attract those leveraging tourism and seasonal demand. For these investors, the DSCR loan represents a way to treat real estate expansion as a structured business activity. Market expanders. A third typical profile is the market expander. These are investors already established in one U.S. rental region but now entering new cities. A landlord with properties in Dallas may look to Miami for seasonal rentals, or an LA investor may diversify into other high-demand states. The DSCR loan framework supports this transition by emphasizing the property's income in its new location rather than the investor's prior financing limits. In summary, the DSCR loan for rental property is most common among self-employed borrowers, portfolio builders, and market expanders in the United States. Each profile highlights how property-based evaluation can shape access to financing in Miami, Los Angeles, and other dynamic rental markets. This explanation is purely educational and informational. This is not financial advice. Talk to a professional. With the borrower profiles understood, the next step is to outline the typical eligibility parameters lenders review when offering DSCR loans. General eligibility parameters. General eligibility parameters in DSCR loans are central to understanding how lenders in the USA evaluate real estate investments. Unlike traditional owner-occupied financing, these structures focus on property performance rather than personal income. This framework is particularly relevant in U.S. rental hubs like Miami, Los Angeles, and New York, where investors seek scalable portfolio growth. Such eligibility parameters allow lenders to balance opportunity with measured risk. At this stage, let's examine the features that frequently appear across lenders and why they matter in the broader U.S. property financing context. DSCR ratio and performance metrics. One of the first parameters many lenders observe is the DSCR ratio itself. Typically, lenders seek a minimum of 1.0 or higher, meaning the rental income is equal to or greater than the mortgage payment. In practice, certain investors aim for a stronger buffer, such as 1.2 or more, to ensure additional stability. In markets like Miami multifamily properties or Los Angeles high-rise rentals, where rents fluctuate but demand remains robust, these ratios serve as benchmarks. They reflect the property's resilience under varying conditions. While no ratio is universally binding, the DSCR score provides a measurable lens through which performance can be compared across diverse portfolios. Credit score and down payment. Beyond DSCR, many lenders also consider creditworthiness. A minimum credit score threshold is often required, not as a direct measure of property income but as a proxy for borrower responsibility. In premium U.S. markets, such as San Francisco or Manhattan, strong scores signal reliability. Alongside credit score, the down payment requirement often exceeds what is typical for owner-occupied loans. These larger upfront investments reflect the non-residential nature of the financing. For instance, a down payment of 20 to 30% is not uncommon for investors acquiring multifamily properties in Los Angeles or Chicago. This ensures that the borrower retains sufficient equity in the property. Reserves and institutional flexibility. Another eligibility feature is the requirement for reserve funds held to cover a certain number of mortgage payments. For some U.S. lenders, this reflects prudent risk management, especially in dynamic rental markets like New York or Dallas. Investors who maintain 6 to 12 months of reserves may be seen as more resilient in market downturns. At the same time, it is essential to stress that these are general patterns, not binding rules. Every institution sets its own policies, influenced by its market outlook and risk tolerance. For that reason, professionals often encourage potential borrowers to review multiple lenders before selecting a financing structure. In summary, DSCR loans in the U.S. are assessed on several recurring parameters: DSCR ratio, credit score, down payment, and reserves. These are not rigid requirements but frameworks lenders commonly use to balance opportunity and risk. In places like Miami, Los Angeles, New York, and Chicago, these factors help shape property-based financing strategies without depending solely on personal income. Understanding these eligibility patterns gives clarity to how real estate financing often works in practice. While this video provides educational insight, remember, this is not financial advice. Talk to a qualified professional for guidance specific to your situation. Weighing the considerations. DSCR loans in the United States invite investors to carefully weigh the considerations before deciding whether this financing approach aligns with their strategies. In high-demand rental markets such as Miami, Los Angeles, and New York, the balance between opportunity and responsibility is central. Some features stand out as advantages, while others are considerations that require close attention. Understanding both sides ensures that investors approach DSCR financing with informed expectations. Let's now explore the commonly mentioned benefits and considerations. Reported benefits. One reported advantage of DSCR loans is the emphasis on rental income, rather than personal documentation. For many self-employed investors or entrepreneurs, this removes hurdles tied to conventional loan processes. It allows the property itself, its projected cash flow, to take center stage. A second benefit involves the scalability of real estate portfolios. Since DSCR loans focus less on individual tax returns, some investors find it easier to expand holdings in competitive cities, like Miami Beach or Chicago. This can provide access to multifamily properties that might otherwise be more difficult to finance with traditional income-based structures. Practical accessibility. Another often cited benefit is accessibility for self-employed borrowers. Traditional lending frameworks can sometimes understate the capacity of entrepreneurs, whose income streams vary seasonally or structurally. By relying on the property's financial performance, DSCR loans create an entry point for these individuals to engage with real estate opportunities. This accessibility can also extend to investors exploring new rental markets. For example, individuals from New York might branch into fast-growing rental zones in Dallas or Phoenix. In these cases, property-based evaluation creates flexibility that conventional methods might not offer. Common considerations. On the other side, there are considerations frequently mentioned by market participants. DSCR loans may involve higher interest rates compared to traditional mortgages. This reflects the investment-focused nature of the product. In addition, larger down payment requirements, often 20% or more, can limit access for some. Another factor is that these loans are restricted to investment properties only. For individuals aiming to finance primary residences, conventional lending typically remains the standard route. Each of these points demonstrates the importance of context. What appears as a barrier in one scenario may be manageable in another, depending on the investor's strategy and resources. In conclusion, DSCR loans in the U.S. present both reported advantages and practical considerations. Benefits include the focus on rental income, portfolio scalability, and accessibility for self-employed individuals. Considerations involve higher rates, larger down payments, and investment-only eligibility. For investors in major rental hubs like Miami, Los Angeles, New York, and Chicago, weighing these elements provides a clear perspective on how DSCR structures fit within broader property financing strategies. This video remains purely educational and should not be interpreted as financial advice. Always consult with a professional before making any lending or investment decisions. Looking ahead, DSCR loans are a unique tool that bases eligibility on a property's rental income potential rather than personal income. We've explored what they are, how they generally work, why they are especially relevant in Miami and Los Angeles, who commonly uses them, and the considerations often discussed. For anyone curious to explore further, the natural next step is independent research and speaking with licensed professionals who specialize in real estate financing. Here on Real Estate Capital and Growth USA, we'll continue to unpack real estate financing strategies from an educational perspective. Share your thoughts in the comments. What topics in real estate finance would you like us to cover next? Once again, this content is purely educational and informational. This is not financial advice. Talk to a professional. Thank you for watching and see you in the next videos.